So we talked a little bit about the top side equation, and I'm going to show you some more examples later. Okay, but now I want to talk about the bottom side, the denominator side of the equation. Okay, so let's just run through this real quick. Okay, this is kind of the investment horizon. Okay, this is what we call the investment horizon. Okay, so if we have cash, it's low return, low risk, and then we're going to move on to bonds. These are like double A, triple A corporates. And then we're going to get into single family homes. Okay. And then we're getting into stocks. Okay. Where do we think small business acquisition is? Okay. Where do you think we are? We're way up here in this alternative space. Okay.
Yeah.
So we should be getting a high rate of return because we're taking high risk. Okay.
Right.
So when I'm looking at a business, okay, and we look, and I'm going to show you an example. So let's talk about this because I just put it for the next slide. Let's think about this price risk for a second, how you can manipulate this formula. If the business is for sale for $1 million, okay,
Yeah.
and you see that the cash flow is 100,000, okay. If you just do that little bit of division here and a little algebra, what is the risk rate that's implied? 10%, right?
Yeah.
So you have 100,000 basically divided by 1 million, which equals, well, so what it's telling me, so here it is, a business is for sale and it's for $1 million. And you go all those add backs and you do all the work, and then you find out the cash flow is 100,000. What is the implied risk rate that they're selling it at? 10%. Okay. Right? Easy math. So then what I do is I go back and I go, well, is 10% risk commensurate to an alternative investment? I would say no, right? Because what is your expected return in the stock market? I don't know, somewhere between 8 and 12, right?
Yeah.
So if we're investing in a small business and not a liquid business on the stock market, we need a higher rate of return. So that automatically tells me that it's overpriced. Does that make sense?
Yeah.
So before I did a whole big fancy LBO model spreadsheet, okay, and did all the Olympics and did all these things, remember, I'm just trying to figure out what's the cash flow and then what risk is implied. What's the risk? Okay. So now let me get down to how we actually calculate the risk. Okay.
Yeah.
If you open any textbook in finance, okay, you're going to see this thing called the weighted average cost of capital, the WACC. Okay. All right. And this is essentially, lack of the better word, the entire study of finance. Okay. People go and get degrees and master's degrees. They have PhDs just over the WACC. Okay. And what this equation is saying, and I'm just going to say it to you here, you have the cost of debt times the weighted debt times 1 minus the tax rate plus the cost of equity times the weight of equity. Okay. Now I'm just going to briefly go over how you would actually find these things. Okay. So the cost of debt, basically you could call up the different loan people. Say how much interest rate are you going to charge me on my loan, right? You could use the company's current debt, right? Basically, how much debt is the company currently using now, and how much is it costing them? Okay. Or you can take an industry average. Okay. Analysts use all kinds of different things to come up with these numbers. And the funny thing is, your WACC can be different than my WACC. Okay. Now, the cost of equity, okay, is the risk-free rate plus beta times the market risk premium. Okay. When I first was starting out, we didn't have all this YouTube and Facebook stuff. Okay. So we had to go to like formal university or textbooks. If you're into this and you really want to know this really in depth, Professor Demoterin, who's one of the titans in valuation, has his NY course on YouTube for free. Is that not amazing?
Crazy value, guys. Hey, check that one out. Professor Damodaran on the
Yeah,
evaluation
Demore,
course.
valuation with NYU. He's the Titan. He's written, I don't
Mm.
know, 12, 13 books on valuation, and they're
Ha,
all on my show.
that's a beast.
Okay. And of course it's on free. Okay. But here's what I'm gonna caution you about. Okay. Is that you're gonna be able to show if you don't understand, okay, it goes back to my theory. Okay. If you don't understand what the risk-free rate here is telling you, and should I use a 5-year, a 10-year, a 20-year treasury, 30-year treasury? 20, should I bootstrap a 25-year? If I don't understand beta, levered and unlevered beta, and why do we use the beta, and you don't understand RM, okay, the number one problem I see people do is they grab these things off the internet, which are available, and then they say, oh, here's my cost of equity, okay? And they have no idea what beta and unlevered beta means, okay? So they're plugging the science without understanding the theory. Does that make sense? But again, all you have to do is do a little bit of background, and he goes through this better than I could ever teach him. Okay. But this is what I do. Okay. In my real practice, I avoid this. Isn't that funny? I avoid this. Okay. And because this is what I do. I developed an assessment guide where I think analytically about a business as opposed to a math equation. Okay.
Mm.
Because the only time I do these math equations, okay, in my practice in real life, is when I am battling against another valuation professional. So, for example, if I am on the sell side or buy side, and there's another finance guy or CPA or some guy who's got an MBA in finance or something, he's on the other side of the table. You best believe I'm going to pull this out because he may ask where I got my numbers from, and I'm going to show him. Okay, so I have no problem jocking on this if I have to. But when I'm doing valuation, I don't really just want to plug these numbers in, okay? Because I want to think before I model. All right, so let me show you. This is just a screenshot of my assessment guide, okay? And I'm kind of actually putting this in app form. So, if you guys are interested, definitely shoot me an email or something. And once it's ready, I can send you the beta or something, okay?
I like that it has the scores. So scores go from what, 1 to 10?
Scores go from 0 to 10.
Okay.
0 to 10, okay? So what I'm doing here is I go, okay, let's just look at a couple of these right here, right? Risk to buyer based on continuing earnings. Okay, so if it's a distressed company, I need to put a 0, okay? If it's a stable company, I need to be around the middle. Significantly growing, I need to be higher, okay?
Yeah.
Risk assessed based on company's age. If it's less than 5 years, okay, let's just say it's a year old, it's going to get a pretty low score. 5 to 15 years, 16 plus years, okay? So a company that's been around for a long time gets a higher score than a newer company. Makes sense, right?
Right.
Revenue grows. Earnings trend. Now, some of these questions are somewhat repetitive, but it's making sure that I have thought about this business. Does that make more sense? Because then what happens is after I do all the score, now it pumps out and gives me the risk rate. And I can say that I analytically thought about the number instead of, or you can go on the internet and plug in your beta.
Yeah, it changes it a lot.
You don't know if you don't like again, if you can't give a lecture on beta, don't use beta.
Yeah.
You know what I'm saying?
Guys,
You need
think then model. Take that one
to think
from Josh.
right? And so this is what I use. Okay. And if I'm using this, is ridiculous. Again, the only time I use this when I'm jocking.
Right.
And guess what? Usually this is pretty close to what I find in this. And if it's off by a lot, then I'm usually not going to take this one. Okay.
So in regard to your score rates, if we could
Mhm.
go back to a slide with the score rates,
Yeah.
from those assigned score, the 5.0, 6.0, 3, and 4, would you say that's a good deal to move forward with, or that's more on the be aware side?
Well, it's a good question, but it's a tough question. Okay.
Hmm.
Because it goes. So here's the thing: if there ends up being a high risk rate, remember the denominator.
Yeah.
If the risk ends up going to be higher, what is that going to do to the price? It's going to push it down.
Okay.
Okay.
Yeah.
And am I saying that you shouldn't buy a business that you can't think you can turn around?
Hmm.
I can't make that general statement. It depends on your skills, whether you know the industry, a whole bunch of other things. Okay.
Correct.
Now, if these scores are really high and the risk is actually really low, well, the business is actually going to be worth a lot of money. And so the question then becomes, yeah, it's a good business to buy, but is past performance a guarantee of future performance? It's not, right?
Mm.
So the goal is that you're always trying to match risk and return. Okay, so
Right.
if the business is risky, you need a higher risk rate. If the business is not risky, it should be a lower risk rate, and then you make your decisions. So unfortunately, I can't give you a hey, if this score all rates out fives, I should buy the business. No, depends
Hmm.
what the price of the business is.
Correct.
If you get a valued business where all these things are five, then I'm
Hmm.
going to tell you that's a good deal to buy.
So that's just one of your various ways of getting an idea of the business, correct?
Correct. It's when I'm looking for the denominator. But
Hmm.
remember, I said we need to spend the majority of our time looking at the return. Okay,
Return.
because this risk rate is important. But I'm telling you right now, if you spend all your time on this and don't find the return, you're going to be wasting your time, a lot of time in private business. Okay.
Right.